What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market, notably some monthly charts there. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. Please don't forget that the market is closed on Monday in observance of Labor Day, so do enjoy your long weekends. And as always, anything that we are associated with is linked down below in the description. Make sure to check it out. And without further ado, let's jump right into these charts. So kicking things off on our SPY monthly time frame, talking about candle structure and location as we always do. For the month of August, we certainly have a nasty inverted hammer there. The upper wick would signify that the sellers really stepped up at the highs, pushed prices back down to the opening print, through the opening print for range expansion, and there is absolutely zero lower wick on the monthly bar, indicating no response from the buyers whatsoever. Dead on the lows, so very, very bearish from a structural perspective on the monthly time frame. If we think about location, it's pretty bearish as well. Although on the bar by bar count, we do have a higher low as well as a higher high. Think about the implications of what's happened over the month of August, right? Number one is that from here to here to here, we're just continuing to preserve lower highs on the monthly time frame. But more importantly, this was an inside bar setup on the monthly, right? Here's the container. Number 2, the month of July marks the inside bar. We broke the container and inside bar high and got no acceptance outside of that range. So this is technically considered a look above and fail with the really weak close back in the range, and we should be headed back down towards the bottom end of the range. That's typically how you look at a look above and fail. So would it be reasonable to expect lower here on the monthly time frame? I would absolutely have to say yes. It is well within reason for the market to continue lower based on this analysis. If we take out the Fibonacci's, one quick perspective I want to remind you of is if we come from the lows of the sickness all the way up to the all-time high, we're still above the 38.2, which technically speaking leaves room for bull flag consolidation to continue here. Although yes, this pullback is firmly a monthly, weekly, and now daily downtrend here. So just pair all of these things together. I just want to give that little perspective that we're still above the monthly 38.2, but yes, from this point of view, pretty nasty month of August with the weak close back down inside of the midpoint of the container bar. Let's drill on down to the weekly time frame and see what else we can learn about the structure here. If we think about the weekly, this really all stemmed from a rejection off of the daily 200 SMA, weekly 50 SMA, inverted hammer up there, and we've seen some pretty serious range expansion to the downside with large red-bodied bars. Last week was no exception. We did fill the little weekly gap to the upside there, so that has been taken care of. Decent move from a structural perspective, but obviously a weak close down on the lows of the weekly range on an increase of volume also strikes me as a bearish takeaway for the upcoming week here. The one sort of quote-unquote saving grace, if you could even call it this, is that we are sitting right on top of what was prior support and then flipped to resistance for this weekly balance, which we've really broken out of aggressively, but this is a 100% retracement of that breakout right there. So is this going to mark the slight slowdown of some selling? We'll ultimately have to determine whether or not we break this level early on in the week to get a grasp on whether or not the selling will continue to magnify or slow down a little bit. And this is really, I know I said last week that we were looking at the 38.2 from this perspective of the Fibonacci, so let's put them on there. We were talking about this kind of being the line in the sand for a higher low pullback. Well, this is it. Like any further than this and kiss it goodbye, like the weekly possibility of a trend reversal back to the upside is completely gone, right? So not only is it the top, well, prior support, then the top end of this little weekly balance range, it's also the 61.8. And based on Fibonacci analysis, any subsequent candle closes beneath the 61.8 greatly increase the odds that you do make the 100% retracement, which of course would just mean massive follow through to the downside in the S&P 500 and preserving the weekly downtrend. This would have been a massive fake out if that's the case. So as of right now, things are not looking good from the monthly and weekly perspective. One thing that I do want to load here is the volume profile that we had been monitoring for quite some time. And remember that the market likes to move from high volume node to high volume node. So Now that we've traversed through the low volume node and we're sitting right on the high volume node again, there's the reasonable expectation that maybe there's a bit of pause here in the selling activity, but things are definitely in the court of the bears so far based on the last 3 weeks of major reversal to the downside. So yes, high volume node, yes, prior support, yes, prior resistance. Maybe the selling slows down a little bit, but the bears definitely do have the upper hand here from the higher time frames. Let's drill on down to the daily now and start looking at some actionable takeaways for the upcoming week's worth of trade. There's the 50 in blue and 200 SMA in green. There are our levels. Let's zoom in a little bit here. Let's see if the platform wants to cooperate. There we go. So expected move. What can we expect for the upcoming week here? Certainly going to preserve the daily downtrend. Here's a high, lower high. Obviously, your top edge of the weekly expected move will produce another lower high. Even if we rally into 408.25, which I don't think is likely, at least as of right now, that would still be a very obvious lower high from here to here to here. So daily downtrend very likely to be preserved. Obviously, if we move to the low end of the weekly expected move, it's just another big lower low. Now, where are we sitting? It's really, really important, right, to note this. We are right at that weekly balance area, but on the daily time frame, it has slightly more importance because it was a break retest for the first higher low and then go. And it's also confluence with our support trend line coming in from anchor point and touch number 1 here. So this kind of area around this 390.85 is pivotal into the upcoming week. Here are my thoughts. I do think that if we stay above 390.85, we will just consolidate and go sideways. We've seen a pretty substantial range expansion to the downside. I think the market might want to digest some of this by going sideways as long as we're above 390.85. Notice that I'm not saying we're in store for any massive major rallies off of this area. If we breach 390.85, that's where I think the gates really open up. Remember that in the past couple of videos, we've been talking about the breaches of the expected moves. Yeah, as we breach more and more of them in a row, it just means that things likely get nastier and nastier and nastier, and we'll talk about why as we get to the VVIX in just a moment. So again, if you're only going to have one level on your chart for the upcoming week, 390.85. Above, I think we're slightly more neutral, not really looking for major bullish outcomes, and below, things really open up to the downside. So let's talk about some of the psychology at play here as well. If we think about what happened last week, remember on the weekly time frame chart, we mentioned that we did fill the overhead gap down. So that structure has been repaired. The buyers tried to make a stand, retrace a little bit of the prior Friday's activity. No luck, right? Inverted hammer there on the Monday session. Sellers in control, breach the low. Obviously, we move lower. We gap down here. Exhaustion move, right? So move into that critical 390.85, fill the gap overhead. And then on Friday, this is the key takeaway from the psychology standpoint, right? If shorts with poor location were going to squeeze out of the market and we were going to see an up day, it would have happened over 399.50. We made the case for that in the pre-market live stream on Friday. It never happened, right? We open, we reject the 50 SMA on the daily, we close the gap and get continuation further for a really weak move and really weak close down at the lows of the weekly range, right above our support at 390.85. So I'm not convinced that that there's going to be any major upside based on all of the evidence that we see here that there's been no short squeeze, shorts are feeling emboldened, and buyers are not stepping up around this critical area. If they were, this gap up should have held, and it did not, right? So those are my thoughts on what the market's doing, what it's trying to do. Downside levels on a breach of 390.85 get us to 386, and the bottom edge of the weekly expected move is 382.50, and also critical support from in here where a breakout stemmed from. After that, we've got a small, but still there, unfilled gap on the SPY daily between 380.50 and 379. So those are the downside levels. Maybe, again, there's a small possibility of trying again for the squeeze over 399.50. I would carry that level forward, and if we can breach it, we've got just minor targets overhead, 404.50 and then 408.25, which, as I mentioned earlier, I don't necessarily believe is on the table for this upcoming week. One last thing we should do here is take out the Fibonacci's. And we're going to do it from two ways. So if we come from the bottom of the rally to the top, obviously we talked about the 61.8. We have closed underneath from the daily perspective. So this dramatically increases the odds that we go to here, right? So that seems reasonable based on all of the bearish analysis that we've seen so far in today's video. The other perspective I want to share with you is coming from the highs. if we could get a click, there we go, down to the lows, to really negate this from turning into a bear flag, we would of course have to move above the 38.2, which is that 408.25-ish zone that we just discussed is not really being likely as a scenario for this upcoming week. So I think there are some more bearish data points stacking up as opposed to outright bullish ones out there in the market currently. Let's take a peek through our sectors now and see what's going on out there from a sector perspective, because the market can only really do what these sectors do in respect to their weight. So the energy sector is continuing to see a break, retest, and hold of this 78.40 level, which again, this is D for defensive. You do not want to see this holding up for relative strength. Not a great sign. It's continuing to point to risk off in the energy sector. If it's going to be risk on, look for a lower high to be produced from here to here and more acceptance to come back down underneath 78.41. But currently, you'll notice that even on the sell side activity from Friday, we did not move towards Thursday's low. So relative strength here in the energy sector does not strike me as good for any upside in the S&P 500. Next up is the XLB for materials, really lightweight sector. We're not going to read into it too much, but again, the gap completely failed on Friday, closed weak inside of the range from Thursday. Strikes me as bearish being underneath this prior flag zone in here as well. So just downward pressure for the S&P 500. If it does rally, it's not going to save the day. And if it were to be like a serious force for the S&P 500, it would really have to come closer to this double top, which doesn't seem likely based on the rejection from the 50 SMA. So anyways, lightweight sector, let's move on. XLF, heavier weight sector, so definitely worth reading into just a little bit. This one strikes me as not as bad as what we saw in the S&P as a whole, simply because we are still firmly above this area, and we actually closed slightly above the lows from Thursday. Don't get me wrong, the gap up failed. There was no acceptance on the buy side higher. There was no short squeeze here in the XLF, and this is the threat currently, but as long as we're above 32.50, I would say, okay, at least a little bit more neutral here. Don't get me wrong, daily downtrend, yes, but as long as we're not breaching this into this prior box, I would at least give it the benefit of the doubt and say neutral on the XLF, especially because, and we'll see this in the rates in just a second, as rates move higher, financials are generally more comfortable with that type of environment. So we'll look at the TNX in just a moment, but bear with me as we get through the sectors. The XLY for the consumer discretionary space, obviously a heavyweight sector as well. Notice that this is firmly above its breakout, break, and retest point from in here as well. So this is actually a decent look for the S&P 500. So far, I would say that this being a little bit more neutral, the XLF being, I would get that definitely more bearish than neutral, but not outright bearish. And pair that with the energy sector, you can see how this bit of relative strength kind of overshadows the concern from the energy sector. But don't get me wrong, we're not out of the woods. Obviously, this is a downtrend, which is bearish pressure for the S&P 500. I suppose I should save the relative stuff for a look at the ratio grid in just a moment, but you get the gist, right? XLI, 7% of our S&P 500. What's going on here? Obviously giving up its bull flag consolidation zone there, rejecting on the Friday gap up. Week close, wouldn't surprise me for this one to move lower or consolidate sideways to digest some of this overall move, but it looks more likely than not that we build out a bear flag here. It would require a higher low above 94.65 for me to flip the script back to bullish on the XLI. Utilities, this is in the D for defensive category, right? So this is a risk off category. Notice that it's coming down, but we really want to see it get closer to that 72 to start feeling comfortable about the utility sector and the defensive sort of nature of that, not being as big of a concern for the S&P 500. So steps in the right direction, but again, relative strength, not closing weak on the Thursday low on the Friday session. So just carry that forward, and obviously it's still closer to the all-time high as opposed to further into the midpoint or chunk of this overall yearly range so far. So not a great sign from the utility sector. XLK, the tech sector, this is where the concern really starts to shine through. Obviously, this is the heaviest weighted sector out there. Notice that we are underneath the break and retest level, right? Not two closes, but one close, 2 days of exploring underneath that 133.85. Not really a good look. Remember, heaviest weighted component of the S&P 500. This is usually going to be what sits in the driver's seat. So really concerned with what's going on in the XLK. I would say there are high probabilities of things producing lower highs. Any dead cat bounces produce lower highs. As long as we're underneath 139.20, bears in control here in the XLK, and it's going to be very, very difficult for the S&P 500 500 to move higher as long as this is below 139. Next up, we've got the XLP for consumer staples. This is technically D for defensive. It's a risk-off sector, and it's playing nicely. I'm not overly concerned with this one. It's in this chunk of range. It's not aggressively leading the pack to the upside, and it's also not breaking down aggressively, to the point where we're like, okay, something's going on here, right? So this is playing nicely, not really looking at this as a big red flag. XLV, healthcare sector, really big red flag that we need to start paying attention to ASAP, right? So we know that this is a monthly range. We're sitting right on the lows of the monthly range. We already experienced a look below and fail. This should have targeted the top end of the range. We never made it there. That's a bearish implication. So from here to here to here, monthly lower highs, right? If we break down underneath this level, maybe there's a bump in the road at 122.66, but really, I believe that the target should be closer to here, 118 over the course of time, which is obviously big bearish drag for the S&P 500. This is the second heaviest weighted component of the S&P 500. If we read into the psychology of the past couple of days, just like everything else, the sellers, if they were going to squeeze out of this, should have squeezed out above 127.16 on the gap up from Friday. It simply did not happen. Instead, sellers are emboldened. We've closed really weak at the lows of this daily balance area. Again, any breaches of 125 get really concerning in terms of the takeaway for the S&P 500. So XLV healthcare sector, definitely keep an eye on it this upcoming week. Next up, we've got the real estate sector, lightweight sector. We'll speed up through these. Bearish underneath its prior breakout point, a couple of days accepting underneath. The close on Friday, obviously accepting underneath as well, would strike me as reasonable to look for either a lower high or just continued drift to the downside here. Not a heavyweight sector, not going to make or break the day. In the S&P, let's take a look at the XLC for communications. This one has already seen its look above fail, target the bottom end of the range. Can we find some support around 53.42? If the XLV starts to bounce off its 125, if the XLC starts to bounce off of its 53.42, if the XLK can get back above that, 130, you're pushing my own knowledge here, 139.20, my memory. If those three things can happen, maybe there's a chance we get a dead cat bounce this upcoming week in the SPY. But overall, I think many of the sector takeaways that we've seen so far today are falling into the bear category. Let me fire up our ratio grid. Here it is. If you don't know what this is, top right-hand corner shows you how to set it up. Here is the interpretation. So this is a relative strength ratio grid. The top four are our risk on sectors. There we go. XLK is falling out of the sky. That means risk off, or at least risk on is not on. So XLK, really bearish look here, not good for the S&P 500 finding a higher low. XLV, although it's starting to curl upward, it's still underneath a downsloping 50 SMA. That's the gold line. So I would have to say that this is not risk on either. XLY going sideways. We mentioned that significant higher low on the daily time frame, at least not to the breakout level. This does strike me as being risk on. So one of three so far. What's the XLF doing? It's starting to curl higher above a slightly lower 50 SMA. So overall, I would have to put this one kind of more in the neutral category, maybe bordering on a small check mark, but overall, risk on is certainly not on. If we look at the bottom four, these are the risk off sectors. What's going on down here? XLP, remember we said it was no concern in consumer staples. It's sideways. It's basically parallel with a sideways 50 SMA. No big deal. What's going on with energy though? Clearly pointing higher, that's risk off. What's going on with utilities? Clearly pointing higher, that's risk off. Real estate sector is just dribbling lower. We know it's such a lightweight sector that I'm not overly concerned with that. So two of these things checking higher for risk off, this one kind of neutral. You can see how it's not quite fully risk off, but it's certainly closer to risk off than neutral as opposed to big risk on out there in the marketplace. So that has been a thorough rundown of our sectors and the takeaways from all of them. Let's take a quick peek at the TNX and see what's going on out there from a rates perspective. We can certainly see major gap up on the Thursday session. Remember that stable rates are a good thing for the marketplace and lower rates are a good thing for the marketplace. Do we have stable or lower rates in this current environment from here to here? Absolutely not. They are not stable. They are trending higher in this section. And obviously, they, as I just said, they're trending higher instead of trending lower. So overall, this is a bad takeaway for the XLK, the tech sector, and a reasonable takeaway for the XLF, right? This is really why we saw that slight strength in the XLF ratio grid here. This is kind of perking up, and I think that some of that is due to the fact that rates increasing are not hurting financials as much as it's hurting the tech sector. So overall, TNX, it's not really boding so well right now for a reversal for a higher low in the S&P 500, because we know that the relationship is that this is not good for tech, and tech is the heaviest weighted component of the S&P 500. So that is that. Let's take a quick peek at volatility. The VIX is what we're looking for. What's going on here? Notice that there was a big downdraft early on the Friday session, but what happened as we sold into the close? Still inside of this little box up here. Remember in last week's weekly watch list episode, we talked about the breakdown of 25 being critical. Obviously, we're still well above that. So there's really no major takeaway for volatility subsiding. I would still prepare yourself for some pretty significant moves out there in the S&P 500. The one thing that we have been discussing recently is that if we are going to see a capitulation type bottom, aka the VIX is going to spike up towards this 35, 38, 40 level, then what does that mean for the SPY, right? If this is VIX 26, 27, and the SPY is only sitting right here, it's probably going to mean the SPY has to at least go to 360, if not lower, for a capitulation bottom in the VIX itself. So just be mindful of that as the VIX continues to stay elevated. VVIX is up next. This is the volatility of the volatility index. And although there was some slight hedging activity that took place on Friday, you'll notice the small green bar from here to here, we're still sitting at very historic levels. And all I bring this up to, or the reason I bring this up, that's a better way of wording it, is to continue to say that when the sell days come, they will continue to come hotter and heavier than you expect until the VVIX would suggest that people are hedged properly. I'm going to start to call this the flooding effect. Nobody's buying SPY puts, nobody's buying VIX calls. So if everybody starts to do those two things at the same time, guess what? You get that spiral out of control where the sell gets nastier and nastier and nastier as the more people start rushing in to protect their downside. So the flood effect still seems to be on the table. Let's take a quick peek now at our market internals. If you don't know what this screen is, again, I've got another tutorial video for you in the top right-hand corner. This is going to basically tell us or give us maybe a little bit of comfort that support may start to hold up here at this critical daily level in the SPY that we've just been discussing. That high volume node that we discussed on the weekly is the 61.8 on the weekly retracement, right? Why do I say that? Well, look at what's going on here with the strength of the selling, right? Tuesday was the nastiest day of them all this week. After that, the selling pressure seems to have subsided slightly from a volume perspective and also from an advanced decline perspective. So Tuesday, nasty. I will say Thursday was nasty as well. But Friday, like some recovery here, some recovery here. It's not like we've been slammed in this zone throughout the entirety of the week. The main takeaway is really the volume when it comes to reading these flows in the marketplace. Again, 300 million is that threshold, and things are subsiding slightly as we've moved off of that Tuesday nasty breakdown day. So what else do we have in the cumulative reads of the tick? They are still all bearish, don't get me wrong, but a little bit of more sideways activity happening on the Friday session. Now, a majority of that's due to the fact that we were holding up decently earlier on in the day. But notice that even as this sell side activity took place, it's not like the advanced decliners went into trend zone here. It's not like the ticks built out a big negative 5,000. And it's also not like the volume outflows suddenly went from here to here in the blink of an eye. So is the selling maybe starting to slow down across the entirety of the broad market? It's a possibility based on what we've just seen here inside of the market internal. So sitting on support, slow down in the market internals, maybe it would be reasonable to expect a little bit of range compression, consolidation, instead of continued expansion in the S&P 500. Next up, we've got the market profile. What's going on here? Main takeaways. Again, if you don't know what this is, by the way, top right-hand corner is going to tell you what it is, how to use it, some of the terms I'm using here. A couple of main takeaways. Number one is that the point of control is continuously migrating lower with price. That is a bearish takeaway. Number two is that we had certainly a trend day lower on Friday. This was not long liquidation. This was not liquidation break. Usually those types of moves happen with a string of A period. It's early in the session. You get long liquidation, then balance into the close. It wasn't the case. This was obviously trending activity lower throughout the course of the day, especially when we failed that afternoon hold above the opening range balance. But again, what are the takeaways? What do I need you to know about here? We did print a string of single prints during H period. So this is going to help us distinguish what's happening early on in the week. If we can get through those single prints and accept above in this section of the market profile, I would, in the upper distribution, right? I would say that we're probably in store for more of a balance type week instead of outright continuation to the downside. If we're just hovering around this point of control and just going sideways, rejecting those single prints, which I'll give you the number is 3950 roughly in the ES. If we reject that, then I would say that this poor low, which is also mechanical, so poor or low here, mechanical because it's back-to-back touches, it's also value area low. If that breaks, we should see a snappy move to the downside to clean that up, and we would have to reassess how that breakdown happens to determine whether or not we will continue to see sell side or it will be a snappy move back above, right? Just as an example, I know we're going on and on about the S&Ps, but if we draw something like this, we get an early week breakdown, then immediately close back above, we're probably just repairing this structure, and I would not continue to carry a bearish slant if we see sort of a miniature, right? Look below and fail on these two lows from right here. So just a scenario I want you to be aware of, especially pairing that with the market internals slowing down. So that's what we've got in the market profile. Back on over to the platform. One more S&P chart, if you can believe it. I know it's a lot of them, but these are all important data points. Here's the SPX A200R. This is the percentage of stocks in the S&P trading above their 200 SMA. And the main takeaway here is that we have something that we have not seen in a very long time. We had a move in July, and then August confirms we had a move in July, rather, that closes back above the yellow zone, and August now has failed that close outside of the yellow zone. Notice here, it was a bounce off. Here, it was a close and then bounce off. Here, it was a close and then bounce off. We retested after moving to that 50, right? Here, same thing. We have not seen this except for what happened in 2008. Sure, you can start to think of this as a bit of a move higher into the 50% mark, but overall, I'm really curious about how this is going to resolve. This is a data point that I'm not an expert in, and I want to bring it to your attention as something that you just add to your arsenal. Could we possibly see a little bit of a double move? Like, is this going to be a lower high and then boom, this collapses all the way to the bottom? That would, of course, look more like what we saw here in '08. So again, I'm not bringing this up as like a panic, everybody sell everything, run for the bunkers, but see the downdraft that we have here? That's sort of aligned with this move. We get a little bit of reprieve. Again, we didn't make it to the 0.5, so I'm not saying it's identical, but then we get the double move. That's where the nastiness of '08 really happens, right? So is this the small downdraft, little sideways? Are we in store for another big one? I'm not entirely sure. It's kind of unfortunate that we only have one data point to go off of here, but it is something that I'm continuing to monitor on the monthly close time frame. So that's all I would like to say about this one. If we do get a higher low out of it, I would say it's a step in the right direction to maybe look something more similar to this or this here, but obviously a little bit lower than both this instance as well as this instance. So something I'm monitoring, keeping an eye on it on the monthly closes. Let's get back on over to the QQQ. I'm going to go ahead and make this our day hour. There we go. We will round out our broad market. I know it's been a lot, and then we'll blast through the rest of the video so we can get you out of here in a reasonable time frame. So QQQ, similar psychology to what we just discussed in the S&P 500. Main difference, already broken the support trend line. We are underneath that, obviously. Your line in the sand level is going to be 295. If we breach that and close below, we're looking for 287.50. Bottom edge of the weekly expected move is there as well. The next line in the sand is 280.80. To the upside, if we are going to see any sort of squeeze, it's over 301.75. 50 SMA is the target, and then again, another possibility of small squeeze over 306.15 to 311. Again, I don't really know that this is on the table for the upcoming week, but those are the numbers that you should be paying attention to. Again, apply all the same psychology from the SPY to the QQQ. IWM Russell 2000 and the small caps, what's going on in small cap land, very similar, sitting right above its breakout level. It is still above its support trend line, so there's that. This is not going to provide confluence until later on, probably 2 weeks from now, so be mindful of that. But overall, bearish takeaways. Again, psychology is the exact same. Let me give you the numbers. The line in the sand, the critical level, that pivot is 178. The bottom edge of the weekly expected move, 174.65. After that, we've got 172.20. To the upside, if any sort of squeeze is going to be produced, I would watch 182. Over that, small squeeze to the top of the weekly expected move, 185. After that, I suppose if you want to keep walking them up, I don't think it's on the table, but 188.35. We will, of course, keep you updated on the Wednesday video. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, let's dive directly into Apple. What do we see on the charts here? Certainly through that support trend line closing underneath the 50 SMA blue line as well. Two equal lows that's usually seen as a weak sort of support. So underneath 155, look for continued breakdowns into 152.40 as a bump in the road, but the ultimate target is here around 150.85 from the break, retest, and rally earlier on in the month of July. What else do we have? If it's going to be a reversal early on in the week, consolidation, then a break to the upside, I would really just focus most of your attention on 160.25. I know I've got a couple lines in there, but 160.25 strikes me as the first place where shorts will start to cover. I suppose the hourly time frame does a better job illustrating this. You can see obviously big reversal there from that area on the Friday session. So if we breach that, I imagine anyone who's positioned short in this area has clearly identified a stop loss above. Stop run happens if we breach it. That's where the quote unquote squeeze unfolds from. So that's Apple. Again, my first thought would be because of the weak close, the failure of the hammer, the failure of the gap, we should probably breach or look for a breakdown of 155 or just bearish consolidation as we sort of digest this overall down move in the market. Next up, we've got Netflix. This continues to be an absolutely boring nothing burger going sideways in this overall range. We are starting to build out a little bit of a head and shoulders look, certainly shoulder one, head, shoulder two. Neckline is kind of this support trend line. That's a terrible drawing, but you get the gist. Underneath 220.75 opens the door to these lows around 215 and 50 SMA. And after that, this is probably the more tradable range that you want to watch for downside under 215 down towards 204.25. If we just remain in the box, again, day trade scalps only. I'm not saying don't do that, but the easier long trade is over 234, gets you to 241 quarter, and then the bottom of that monster gap from 2 earnings cycles ago. That's roughly 250 on the upside. Next up, we've got Tesla. What's going on in Tessie? Taking a look here. Again, similar psychology to everything that we've discussed thus far. Big failure of the gap up, failure of the hammer candle to produce a reversal, closed right on the 50 SMA. There's another dynamic at play though here in Tesla, which is the breakdown of this daily range overhead. So not only are these people all overhead supply, but we have a break, retest, and failure. If we move underneath that 266.50, doors are wide open essentially into the lows around 254.84 coming from the low end of this. Remember that although this may look like there's some daily structure there on the hourly chart, you can clearly see it was straight up, it was straight down without very many pit stops along the way. Maybe there's a bump in the road around 268, but I would not bank on that whatsoever on Tesla downside. So 266.50 is your sort of gatekeeper for that down move. If it's going to be bullish, again, got to see a candle close above the bottom end of this prior range that we had just outlined, above 280.15 for the cleaner bull trade, at least something that, higher lows above there. Maybe longs are back on the table, but so far bearish digestion and breakdowns. 266.50 is the number. Next up, Google. What's going on in Google? Clearly a bear flag. Again, very boring. Sideways consolidation, balance in play here. Bearish engulfing bar on the Friday session. Although the close was now not outside of, that Thursday range, the low was certainly slightly lower. We undercut it by just a little bit. This is slightly concerning because although, yes, bear flag consolidation, yes, bearish engulfer, the fact that the sellers breached that low and there was no follow through, granted it was late day, right? If we look at the hourly, we can see this. It was like late day into a long weekend. But generally speaking, as you breach very obvious levels like this, especially after multiple days of consolidation, there should be some sort of stop run. There should be new sellers attracted in this area. Maybe it has something to do with it was late day on a Friday before a long weekend, but I'm just not loving the fact that the sellers didn't materialize very much on the breach of that low. So yes, is it bearish? Yes. Is it, sort of bear flag consolidation, everything stacked in the bear favor? Yes. But I'm just open to the possibility that, okay, if these people have, proven that the sellers are going to fail here, consolidation and a breach of 110.50, my goodness, that catches all of these shorts off guard and boom, I would expect a move quicker as opposed to slower, sooner rather than later. Whatever analogy you want to use, up into 113.50, right? So that is the analysis of Google on the hourly and daily, really just watching this bear flag and the fact that the sellers didn't do much underneath that Thursday low. Again, maybe it has something to do with the long weekend and timing overall. Next up, we've got Metaverse, Mark Zuckerberg. What's going on here? Obviously failing again at the 50 SMA. 3-day balance starting to breach to the downside. I would say that downside should be the favored outcome of this chart into the bottom of this overall range right here. And after consecutive lower highs here, I would say that, again, a pretty decent sized short could unfold under 155.65. Big breakdown here in Meta. That obviously would not bode well for the XLC as a sector, which we know is weak on a relative basis anyways. If there is going to be longs, it's got to be on a recapture of these 3-day highs, 167.25, back to the top of the daily range in here. Again, nothing about this bearish engulfer from Friday would suggest that being a possibility early on in the week. Next up is NVIDIA. Complete and utter destruction in NVIDIA with the big gap down happening here. Friday accepting purely inside of the hammer. No love into the gap overhead. No daily buy setup. Nothing. So overall, bears still in control. I would watch your 136.40. If that breaks down to the low of Thursday, we go 132.70. And after that, some previous supports are around 127.82. If I scrunch this up, I'll probably have to grab more time here. Let's go with 5 years just to make sure we're covered. Plenty of time. Notice that, and maybe you actually remember this period of trading, but NVIDIA was so boring for so long, doing absolutely nothing in these stages of trade. I almost considered taking it off the watch list. That's neither here nor there, but that's where these supports are coming from, right? If you think about, if I drop this, let's do volume profile. Yeah, you're just barely starting to see it on the weekly here. Notice that massive shelf of high volume, right? So that's kind of where we're coming into just on a higher time frame perspective. So be aware of that NVIDIA, although yes, it is nasty to the downside, may start to slow down based on coming into this really congested area from a volume perspective. Let's drill back on down to the daily. We'll pop on our study set, 50 and 200 SMAs. Good, and we're moving on to Microsoft. What's going on in Softy? Zooming in here, certainly a more intense bearish engulfer on the Friday session with a failure to move higher first and a close right on the lows of Thursday. Obviously, bearish trend still intact. Nothing to do on the bull side until we breach these three highs around 266.65. For the rotation here, scene of the crime. Strikes me as a bit of a stretch, at least early on this upcoming week. To the downside, you're watching supports at 253.50. Breaches of that walk down your supports 248 and 241.50, ultimate line in the sand from this area here. Overall, again, the complete failure from the buyers or any short squeeze to unfold over Thursday's high. I think the sellers definitely have the upper hand here. Next up, we've got Amazon, last but not least, the mini beast. What's going on here? Closed most of this prior earnings cycle gap, and I would say that this is actually a little bit relatively strong just based on not closing firmly on the lows of the Thursday session. We're also still above the 50 SMA. Maybe that's a small saving grace. This range is fairly choppy in here. I would say that most traders want to wait for a close above 132.50 for the rotation higher to this lower high here, 136.70. That could easily be a day trade or a day or two swing. If we're just consolidating in the gap, my outlook would be for lower underneath 125.25, first stop 121.75, and then 118.50. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all of those buttons YouTube tells us to tell you about, and let's get directly into these trade ideas. First one is on PDD for Pinduoduo, and what are we seeing here? Certainly a bull flag in the face of a falling market. Really interesting look, holding up nicely after that earnings cycle there. So if we can get some activity above 72.15, and as long as we stay above 68, I would say bull flag remains in play, looking for breakouts to the upside here, just based on some relative strength. If the market sees a dead cat bounce, this might be a place to look. Obviously, this is an Asian company, so be mindful of any headline news that comes out that might affect this. Target overhead 78.25. Again, not interested if we breach to the downside 68.10. Next up, we've got Uber. This is just a simple trade to be watching, which is why it made the cut this week. We've got a very easy to identify balance range over the highs. 200 SMA and scene of the crime is kind of the target around 31.50. If it's downside, obviously a breach here gets really interesting for not only the 50 SMA, but notice we've got an earnings cycle gap up. So I'm not saying it fills all in one go, but over time you'll notice that there's fairly thin structure here, so downside might be attractive if the market continues lower underneath 27.80 inside of Uber. So lots of possibilities there based on a daily balance. And then we've got TMUS for T-Mobile. What's happening in this one? Certainly multiple lows all stacked at the same area. Boom, 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 boom. Finally closing with a bearish engulfer underneath all of those lows on the Friday session, 142.48. As long as we're below that, again, look left. I'm not saying we fill the earnings gap, but I would say maybe that would be a reasonable expectation around 138.36, the prior breakout level, right? Resistance, 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 so on and so forth. Get the break and it holds. So those are two downside trades in PDD, some relative strength there with the bull flag if we need some sort of long idea for the earlier part of this upcoming week. If you made it to the end of the video, thank you so much. I appreciate you. Hopefully you enjoyed it, learned something new. If you did, let me know in the comment section or by giving the video a thumbs up. Remember, the market's closed on Monday. I wish you all a great trading week, and I hope you enjoyed the long weekend. With that being said, we're wrapping it up. See you live Tuesday at 8:30.